Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis on Tuesday, August 26, 2014. Here's a daily chart of the SPY, and as you can see, the market made another new high, and it's just light volume, folks. This was, I think, if it wasn't the lightest volume in years, it was pretty close. The whole thing on this spider today was 47 million shares, and that's pretty light. So what we have is a market that's going into the Labor Day holiday weekend in float mode. You have one more chance, maybe tomorrow morning, for a down move just to work off some of this overbought condition that we have. But we may not get much. We may not get anything. We may get 10 or 15 points in the SPY, and then it'll bounce back. I think going into the weekend, we'll see higher prices than we have now between Thursday and the half-a-day Friday, regardless of what happens tomorrow. So that's my take on it. It's just from, watching these type of long holiday weekends year in and year out and just seeing the same thing repeat over and over and over again. We typically will float up into the holiday weekend. And then next week when we get back, I would look for the light volume to continue for at least a couple of days before things kind of get back to normal. And then between the latter part of the first week in September forward, you could expect the volume and the volatility to pick up. You could expect the market to begin to work off the overbought condition. And then you can also look for new lows below this number here. And we'll talk more about that as we start down that path. But that's what I see happening over the next several weeks. And we're going to stay on top of it, and we'll trade it for the members. We'll have our swing trades accordingly, and we've got a whole laundry list lined up of stuff, and we got a couple out there setups now that we were in already, but I have a whole laundry list of stuff that's going to be released most likely in the first week in September after the Labor Day holiday weekend. So that's that. There's not much else to talk about on the S&P. So let's just slide over to the GLD, the gold market. And GLD was up 61 cents today. Started to make a little bit of a move earlier in the day, but then it pulled back. So, I don't know what to make of it. I just don't see any sign that GLD or gold is ready to move substantially higher yet. And yeah, most likely there'll be a day where it catches everybody by surprise, up $25 or something like that in gold. That happens a lot. But you got to see. Let me show you what I mean. I'm going to go over to the weekly chart, and here's a better picture of what I'm looking at from a longer term perspective in gold. All right, this is again GLD. So we put in a low here in the beginning of 2013. Okay, I'm sorry. This was in the end of 2013, the beginning of 2014. Okay, then we rallied up and pulled back, but we made a higher low. Okay, that's a bullish sign. All right, then we rallied up and we're pulling back again. Now you see we're into this big green bar here, and I would suggest that if we don't hold this green bar by Friday, okay, on a closing basis, then we're probably going to go down and test this number at minimum, which is going to crack 120 in the GLD. So, however, if we start to get some rally going over here, okay, and then we make a third higher low, that's a big deal. So that's kind of where my mind is with gold and GLD. So I'm not ready yet, and that's where we sit. So let's move along, and we'll go over to the USO, and we might as well start out with the weekly while we're there, because here's my number. Nope, my number's down here. Okay, $34. However, if we continue, you see how this sideways is going on. If we go sideways next week, and then we could be susceptible to a further breakdown, and then we could begin to talk about testing these lows. But that's a little way off. I'm not sure yet, but we should get a bounce at a break of $34. That's in my book anyway. So we'll see what happens there. If you go over to the daily chart, we'll work backwards tonight. You see, a little bit up, but we're still in this sideways pattern here, this sideways action. And if we get another several days of this sideways action, we're going to go lower. That's just the way it is. You have the averages, the 20 and the 50 period moving average sloping down underneath this on the daily basis. Okay, you have a weekly chart that is very, very weak and starting to consolidate sideways maybe. There's just no support in here. There's no reason to own oil. And it's really crazy with all the stuff going on around the world. Oil's weak. So that tells me that it's deflationary. And when you talk about deflationary, if oil is deflationary because the need for oil will be less, because deflation means that asset prices go down, which means if asset prices go down, that means the value of our assets go down. When the value of our assets go down, we have less money to spend. When we have less money to spend, we buy less things as consumers from corporations. When we buy less things from consumers from corporations, the corporations make less money, and when they make less money, they have to make less stuff. When they make less stuff, they use less energy. And when they use less energy, oil goes down. And that's the long version of the philosophy on why this may be occurring. Maybe the price of oil, maybe the oil market, the participants in the oil market are sniffing out inflation. Maybe the bond market, this is a great opportunity. Let's check out the yields again. Maybe the bond market this is a weekly, maybe the bond market is sniffing out deflation. And what I mean by that is if yields continue lower, this is the 10-year yield, okay? If yields continue lower, I mean, we could be headed down to 2% in the 10-year again. Let's go back to the weekly chart. If yields continue lower, that would mean that it's likely that the Fed, here's your 2%, right? All the way down here, okay? I mean, it's very hard to see it right now, but it certainly could happen, all right? So if yields go lower, all right, then that means bond prices are going higher, which means people are anticipating, the market participants in the bond market are anticipating that the Fed is going to have to stay involved and try and liquefy or inflate markets. And you say, well, the market's already inflated. Yeah, but if the market comes down and it comes down hard, the Fed's going to be forced to get involved again. And that's what the bond market may be sniffing out long ahead of time. It may be sniffing out a down move in the stock market is what I'm really saying. Okay, so all these things are deflationary. Assets go down, stock market prices go down, that's deflationary. If the price of real estate goes down, it's deflationary. If the stocks, obviously, if the stock market goes down, the individual stocks are going down, the corporations are making less money, all deflationary. So these are the things that on the macro side, on the macro scale, that we need to pay attention to. Okay, it doesn't necessarily help us on a day-to-day trade, but it's important to know what the bigger picture looks like, because the bigger picture certainly dictates how we play on a day-to-day basis in the markets, okay? Because we have to be aware that at any given time, okay, if I'm right and the market is going to come down and come down substantially, at any given time, it could come down a whole lot in one day. And we've seen it in the past, and we're going to see it again in the future, so you don't want to be caught by surprise. So if you're long the market, you want to make sure you have your stops in, so on and so forth. So that's enough of the soapbox on the macro side. I think that's pretty good for tonight. I'm going to leave it there. This is David Frost, mystrategicforecast.com. I appreciate everybody tuning in. Thanks, folks.